So that's too perfect an answer already. I think viewers that come onto YouTube, right, they want financial advice. So now let's go back to this 100,000 thought experiment.
My mistake is that I didn't go and double down when the price doubled, you know. But once you buy already, then the price drop another 30%, then you ask yourself, what am I doing? So that's another story, right?
So I'm investing $100,000 here in 2025, but my friend has a different idea. And this is a new topic idea created by a fellow YouTuber, Josh Tan, over at The Astute Parent. So I thought that this was a fairly interesting topic, and I think the genre or the flow of the discussion was not really what I expected. So of course, please feel free to support a fellow YouTuber as well. I'll leave the link to his video in the description below. I was feeling a little bit maybe unsatisfied. That's why I dropped the text to Bunti late at night, right onto the same topic, but also provide our own opinion on this. So that said, I think Bunti has very readily agreed to come on, and we are just gonna expound on this thought process in current context. Today, you look at many of the markets out there, specifically the US market. It's led by this very strong AI and tech rally. And some of you might be wondering today, if let's say I just got my bonus, or maybe I even got an inheritance of $100,000, what should I do? And coming from two very different perspectives, investment philosophy, and just styles in general, I think let's not try to constrict our discussion to, this is not financial advice. All of us have different risk profile and stuff like that. I think let's just come from the perspective that today you have 100K. How are you going to deploy it? And you must deploy this 100K. Yes, you can keep it in cash, but how are you going to allocate the capital per se? So Bunti, I think maybe we'll just get the ball rolling. We did our own homework. We tried to post or give each other a heads up first on how we're going to allocate, and we're trying to poke holes in it. So Bunti, maybe you want to give a starter context on your own investment style, and we'll maybe put in a screenshot of your current portfolio, and how would you reason through this question about allocating 100K in 2025 in the current US all-time high market?
So when you ask me these questions, right, I'm thinking that, okay, usually my standard answer is very straightforward one. How I'm going to allocate 100,000, let's say a fresh capital, right? It'll be almost the same as my current portfolio. It shouldn't be that different, because if I have a very different answer, right? Say for example, I own stock ABC, but I'm telling you for fresh money, I'm putting in into a company that is XYZ, right? Then why don't I just sell my current portfolio and just rebalance, right? I mean, the team wise, right, it will be quite a similar team. So if you look at my portfolio, right, I would say that still the largest positions are all the tech companies, US companies specifically, and only like, okay, maybe TSMC is not considered US, but their business are still quite US centric now. So that's my current portfolio. And just to touch on briefly on what's my strategy, right? So for those who don't know, I have a Telegram group. The name of the Telegram group is Invest for the Long Term. When I put my money to work, right, I always think about like, how should I allocate my portfolio, having let's say like a 10, 20 years kind of outlook. Not to say that, oh, I just want to optimize my portfolio for the next 1 year or next 6 months, whichever hot stocks or hot industry I just get in, and then when things are shaky, I just get out. It's not like that. It's really looking at things, see where are the overall trend going, and where I'm talking about like long-term trend. And once I spot those trend, right, I would just stay invested for as long as possible. So that's my strategy.
If you want to catch the latest market trends like the DeepSeek saga, Moomoo's 24-hour news provides timely information for all market changes. And you can also find a related stock list on it. And Moomoo also provides free tools to help you identify market opportunities, such as the market position analysis, and you can possibly map out the resistance and support lines of a particular stock, or even the technical setup to see the current market sentiments. So you must celebrate the new year with Moomoo, as they're offering ang pao deals worth up to 3,154 Singapore dollars. It's the perfect way to start 2025. So here's the deal. New users to Moomoo can now sign up for an account with my link below, and you'll get 30 days zero commission for the Hong Kong stock market and lifetime commission free in the US market. On top of that, new users can get up to 1 free Tesla share and $20 worth of cash coupon, which is an affiliate exclusive if you use my link below. So for those without $100,000 in capital, to qualify for the highest tier of sign-up rewards, you can deposit at least a cumulative amount of 3,000 Singapore dollars, complete 3 buy trades, and maintain the assets for 30 days. And you'll get $20 in cash coupon plus an additional 0.1 Tesla shares, worth roughly 47 Singapore dollars. So that's $67 worth of rewards in 30 days. 2.2% of a 3,000 capital base. And for those of you who have created a Moomoo account before but have not made your first deposit yet, you are still eligible for this sign up promotion. So all you have to do to get this special deal is to log into the app, search for a special deposit, and click go, enter the promo code CK88 and make your first deposit. You'll then be able to enjoy the new user rewards mentioned earlier. Oh, and did I also mention that you can get an interest booster of up to 6.8% per annum for the first 30 days if you park your money with Moomoo Cash Plus. And I heard that this promotion is ending really soon. So for those of you who are still sitting on the fence, don't wait any longer. So this sign up reward campaign will end on Valentine's Day, 14th of Feb 2025. It's the last call. Sign up link will be in the description below, and thank you Moomoo for sponsoring this video. Very nicely put. I think you talk about investing into semis, and I think we can see the breakdown. You have a very big exposure to tech and semiconductors. So no doubt that you have done very, very well over the last, I guess, 4 or 5 years, despite the two bear markets that happened, right? But they all recovered very strongly. I think then the bigger question that people always ask is, yes, they are very popular now. Everybody knows, even my mom that doesn't invest, she knows that Nvidia is making the news. You see it in headlines, and it's becoming the if not, it is the most valuable company in the world. So it's like 3 trillion plus, sometimes up down because of DeepSeek and whatever. But all that being said, is it still a good time in 2025 to allocate fresh capital to all these companies that are trading at relatively, I think historically speaking, at one of the highest multiple? They all have a lot of expectations being baked into them. Still can buy in 2025?
If you ask me these questions, let's say 4 or 5 years ago, right? I think the answer would be the same. The answer is like yes, yes. Why? Because the long-term trend is there, right? But the similar situation is that if you look at valuation multiple, right? Let's say you take price over sales or price over earnings, it looks high. So I think you can see that for investor, right? There are mainly like two group of people, right? One group of people, they just focus on the timing part, meaning that they want to buy, but they don't want to buy now. And when they are going to buy is they wait for valuations to come to a so-called attractive level, then only invested. And then there are another group of people which I belong to the second group, which is that I look for businesses that is worth invest for the long term, pay less attention to the valuations and just get get some exposure in first. And of course, when the opportunity come, of course, you add to your allocations, right? If you just keep on waiting, sometimes, yes, the valuations can come down and then, okay, hit your threshold, then you get to buy. That's, good for you. But let's say if the valuation just continue to stay high, but if you track the fundamentals, right? Say, for example, the revenue, the earnings all continue to go up, right? Then you will just completely miss the opportunity, right? This tendency to say that, oh, just focus on the business. Once business is good, just hold on to them, right? It's because I think that for companies that is really, really, have good quality and good management and enjoying those trend that is very obvious, right? Actually, these type of companies, once you go through the screeners, right? Not like you can find like 100 companies. If you are able to find, let's say, like 200 good companies, right? Then I would say that, okay, then you can be very, very disciplined when it comes to the pricing. Pricing not good, you just leave one company go, then you still have 199. Even you give up like 10 companies, right? You stay at 190, right? So not a big deal. So you can be very disciplined in terms of the valuation, in terms of the pricing side. For me, right, the filter is like very strict such that if you look around, right, there aren't that many companies that pass all this filter. So then most likely is that, okay, for those that pass this filter, right, and usually these are also companies that other people also know that it is good. It's not like you are the only one person that know it is good, right? So it will look expensive, but as long as the growth rate is there, able to justify, and you can see a clear future. Sometimes that future is not like just 6 months ahead or 12 months ahead. It could be things that is like 5 years ahead, 10 years ahead, right? But it's quite clear that we are heading to that direction. So you just need to be patient enough to just wait for that time, right? So come back to your questions on like Nvidia. Can we still buy? The questions, I think we also discussed this in the past, right? It's like when you look into the future, right? What do you see? Some people will see that, oh, I see that the sales will come down. Why? DeepSeek is here. So they read all this newspaper, they say that, oh, because let's say the DeepSeek model can operate at such a high efficiency, you only need a cheap GPU. You can even host it using your PC. So the sales will come down. And I'm not saying that people who make this kind of comment, right, I'm not saying that they are wrong. In fact, they could be true. If you just track, let's say, 3 months, 6 months, 12 months ahead, these so-called lower orders, right, can be the right things to project. But if you ask me, I don't look at 12 months ahead. I want to look at 10 years ahead. And 10 years ahead, right, what kind of world that we are living in? And in that world, right, what kind of hardware that we need to power all these things, right?
In the benefit of hindsight, now you're already 10x right on your position on Nvidia. Let's say that I have zero position today. So going back to the topic at hand, you have 100k capital. How are you gonna allocate this 100k?
When we talk about 100k, right, we're thinking about like things that is more, like tangible, like how exactly are you going to deploy, right? So on top of my head, right, let's say if I start my portfolio fresh, I will also allocate like this. So there will be a 3 bucket. Okay, the first bucket is that I really look for all these companies that enjoy like all this trend, long-term trend. It could be tech. I mean, usually they are tech because to me, I monitor this space quite closely, and I think I can see where's the tech is going. Like all this AI stuff, generative AI, to me is very clear trend. So this is one, which is all the autonomous driving also could be one, right? So all this technology trend, that's 1/3 of the money will go. And then the second bucket, right, will be just, I'm a bit also like those FOMO, fear of missing out, just into passive ETF. I can say, for example, take VWRA or IWDA, all these, broad-based ETF, right? I just want to have one instrument that cover the entire world, so that I have, like 5,000 names inside this ETF, so that I have exposure to everything. This is to hedge that what if all the trend that I mentioned, right? If I got it wrong, right? At least for the companies that will, the top performing companies over the next 20 years, right? Confirm I have some exposure in. So that also helped me to be more disciplined when it comes to the first bucket, because once I have this, let's say like a passive broad-based ETF, right? My criteria will be very strict on the first one. I know that, let's say people talk about, let's say Palantir. After do some analysis, I think that I'm not going to invest because I don't understand this company enough. But I just tell myself that, hey, actually I have some exposure through my second bucket. So that's where the passive ETF comes from. Third bucket is like, we are all having itchy hands, right? We want to buy stuff, and sometimes we want to buy stuff that is cheap. Okay, so I think it's like the third bucket usually is allocated to those opportunity that I think is only available now. We don't get the opportunity to buy at this kind of valuations all the time, but somehow, it could be, penalized by the market for whatever reasons. So I'll give some tangible examples. So the first one I think of when I talk about this third bucket, right, it will be Singapore REITs, because we all know that Singapore REITs hasn't been performing that well over the past. But I do think that current valuations is attractive enough. By attractive, I mean, let's say if I just put my money into REITs and then I get something like 5 to 6% dividend yield, just assume that the valuations remain the same, right? So to me, 5 to 6% is still quite decent. It's still better than bond investment. Price went up, right? Then you might want to adjust already, because today it is cheap doesn't mean that 3 months, 6 months, 12 months down the road when you watch this video, right, it could be already expensive. So you need to like change the idea for so-called the opportunistic kind of investment. The other one, which is your favorite, chicken, which is China, I will still consider today's valuation is cheap. So that one can also fit into the third bucket. But this one, the caveat is that you need to be comfortable taking all these geopolitical risks, China risks. China stocks can come down another 30%. You need to be okay with that. But this third bucket is that, the names they could rotate one. Today is REITs, tomorrow could be tech, which are the spots where the market really hate them, and then you can see that the valuation is good.
When you talk about first bucket, when you talk about semis and tech in general, I don't need to quiz you on the names because I think it's quite evident in your portfolio exposure, right? But would it be a one-time add, meaning let's say 3 buckets, 33k each? It will just be you decide on the allocation and then you immediately deploy the 33k to that desired allocation, or would it be a gradual add?
Like, should you DCA or should you just do a one shot, right? How to say, to minimize your regret, right? Is that you really DCA is the better approach. And if it goes up, then usually you will just ignore about it. But let's say if it just come down by just 3%, right? You will say, I should, just wait for that price to come down another 3%, then only I buy, right? So you will always have that kind of emotions involved. Take time to DCA, but you also don't want to say that, 100K, I just take, like that 10 years to DCA. It also doesn't work, right? So for me, I would say that just DCA across 12 months and then just get it fully implemented. Then you can just focus on the next things to do. You also don't want to, play that timing for too long. So 1 year to deploy, let's say 33K divided by 12, right? It's like 3,000. To me, that's a good amount to deploy.
It seems to me that there's no allocation to cash or to bonds or to money market fund in the short term. So
Yep.
how do you see people talking about like having war chest or having wartime cash, getting ready for the next bear market?
Yep.
Do you personally have one now? And if so, actually in this 100K thought experiment, why do you not allocate at least like 10-20% to at least hold as dry powder?
Okay, you need to differentiate between dry powder versus a permanent allocations. So if you know that you don't have the the capability to withstand volatility, right? So how you help yourself is that you have a permanent allocations into something that is safe. You can create treasury bill or you Singapore saving bond or some bond funds. But once you figure out the number, right? Let's say it's 50-50. You say 50% I'm okay with equity, 50% into bonds. I'm fine with that. To me, that's permanent allocations. Once you have that permanent allocations, right? I think the right thing to do is you just rebalance. So you continuously do that so that you have allocations that fit your risk appetite. I think that's the right thing to do from risk management perspective. But for me, right, I don't really have a fixed allocations to bonds. Really, my saving is really safe for, let's say, like 10 years, 20 years, 30 years down the road. These are long period, right? So long period of time to me, as long as I can take the volatility, I think they should be in equities. Having knowing that I don't have a permanent allocations, right? Then the question is that is that means that I'm 100% in equity all the time? Not really. It really depends on the opportunity at the time, right? So to your questions, right? Do I have cash? The answer is yes. Okay, because in the past 2 years, I already slowed down my investment. I didn't really fully deploy every month, right? So I really have some saving. For me, what can I do? I just take the cash, and anyway, I have a mortgage, right? I will just pay off my mortgage. So that's how I see that liquidities.
You are basically explaining your own context and how you look at the
Yep.
allocation wise, right?
Yeah.
So that's too perfect an answer already. I think viewers that come onto YouTube, right, they want financial advice. So now let's go back to this 100,000 thought experiment. Yes, you can say that it's short term thinking and whatnot, but I think it's a very real issue where let's
Mm,
say today you really have a big bonus coming in and then you don't know how long you're gonna deploy and
mm,
how much you're gonna deploy. You can talk about wow, my one third bucket here and there, but
mm.
so how much do I put into the market today? I want to talk about when Monday market open, how
Yeah.
much do I go and buy in the stock market?
Take aside, right? The neutral way to allocate is just saying that, now suddenly 33,000 every month, just, what, 33 divided by 12, how much? Almost 3,000. Then I'm
So
okay with just 3,000 this month. And then next
okay,
month, another 3,000. That's for the first bucket. And
right.
then same goes for the second and third buckets. I'm fine with that.
So
Knowing
so
that,
meaning to say
yeah,
your timeline to deployment would probably range around 6 to 12 months lah. So
yeah,
you
yeah,
you do
yeah,
a 12 month and then you deploy.
yep,
Okay,
yep,
that's good. Okay, second question. I think on the second bucket is the idea of buying into indexes, right?
yeah,
So there is always the age-old debate that you want to have passive exposure and whatnot. But the one that really stood the trial or test of time is really S&P 500.
mm,
Even you talk about because you say long enough time horizon, and
yep.
let's assume that the viewer here is really have long time horizon. Why are you wasting time with global equities? Why not just all in VOO or S&P?
So the goal of this bucket is not to miss out, right? It's not to miss out. That not to miss out meaning that I don't want to miss out into the big winners. So by having a broad-based allocations, you have all winners, right? And then if you just now we don't talk about the individual stocks. We talk about, let's say, just geographic, right? And when we talk about geographic, there are mainly few area, right? First one is US, second one is emerging market, and under the emerging market, largest one is China. Is China, Taiwan, Korea. When I say not missing out, right, you need to imagine that, we close eyes now, right? Suddenly, wow, China just keep on running, like running, 30% every 6 months, up 30%, 30%, 30% every 6 months. Then you don't want to miss out to this rally, right? So if you just already have broad-based ETF, but it is only broad-based inside US. The moment China rally, emerging market rally, you are like, okay, what am I doing here? This market is supposed to cover, the broad-based. Broad-based means they cover everything, right? So you need to have something within that bucket to cover things that you don't have in the first and the third bucket, right?
But can I clarify? Because you were floating
Mm.
names like VWRA, right? They're still
Yeah,
very, very US centric and
yeah,
heavy,
yeah,
if I'm not
yeah.
wrong. So
Yes.
would you then be constructing your own ETF?
So specifically, I really look at my China exposure. So my China exposure is not just the names I have, right? Because for example, I have Tencent, Meituan, so this one included already. At the same time, I also have some ICHN, which is MSCI China, and then also I have this China A shares ETF. So when you look at that, you slice it according to geography, right? You see the total exposure. And to me, the total of all this, right, it doesn't need to be like 50%, right? It doesn't need to be, because I know that globally, let's say talking about China, their exposure is probably around, let's say 5%, right? Or even lesser, depending on which time period that you are looking at. So if the global market allocate 10% or 5% to China, as long as I have 10% to me, that's enough.
But when you talk about the third bucket, right? Things like undervalued or things like you want to buy things cheap or more speculative in nature, lah, in
Mm,
a way, because you are doing constant like reallocation, or if you think it's expensive, you'll sell out. I wanted
yeah,
to ask, like, do you have a benchmark or a process for this so-called like rotation, or when you hunt out for all these undervalued opportunities? Or
yeah.
is it more like because you are very plugged into the market, you have intuitions, or your feed, they always feed you different things, and then you listen to a lot of news sources, and then you get your idea that, oh, maybe this value or this sector is more potential or stuff like that. I just wanted to know, like, is there a institutional process,
No.
or it's just like based on how you feel or how you think about the market in general state?
Yeah, no institution process. I'm retail investor, right? So I only manage my portfolio. So definitely no lah. But sometimes simple stuff works lah. I would say for in this case, let's say if you need to pull out your spreadsheet and then your spreadsheet is like 10 different tabs, right? In order for you to tell you that names is cheap or expensive, right? Usually, I think you are most likely confused than informed. So
Right.
usually these
But
are simple things.
on
Yeah,
on the side note, yeah, that's for cheap stocks lah. So that's
yeah,
why I really like to look into these like so-called undervalued sectors or unloved one. Because
mm,
case in point, when you see some of these other names that went through the bear market in 2022, especially in the
mm,
US market, like, it's easier to tell. But
yep.
I think on that same note, when I try to justify companies like Tesla and Nvidia, not trying to bash them, I really need to pull out 10, 20 Excel lines to and try to figure out their valuation, because there's a lot of storytelling and imagination that needs to
Yeah.
go into their margins and growth rates. Lah. Respectful of your ability to hold both ways, because on one hand, your first bucket, you always think about like in the future, your projection and a lot of the imagination. And
Mm.
on the other hand, you can still play with this style where you are more number centric, more quantitative, more, or that's cheap. Be playing both sides of the coin, because you usually see somebody is like high growth or in Tesla, Nvidia, whatever, or the other side is, well, only buy value stock, cheap stock. Tesla, Nvidia say will go to $20 or something, and then
Like quantitative stuff, right? Like when we talk about valuations, right? I think when a company is cheap, usually it's quite obvious. It can be very obvious. The caveat is that cheap doesn't mean it will go up. That's the only caveat, because sometimes it's like, oh, from a 20x PE drop to 12, you think it's cheap, then you buy and then you drop to 6 PE, 6 times PE, right? So it's like, oh, what does it mean? I bought cheap, then become cheaper. Yeah, I mean, it could happen, right? When we talk about cheap, usually we are referring to, oh, the valuation is very cheap. Usually we are referring to, price over earning multiple. And sometimes for those who look at balance sheet, you can look at price over book, right? So these are the metrics that there's like nothing new one. People already analyze all these things. I mean, the economic stuff is already there, and it is not too difficult to understand. The difficult part is really doing the homework. But once you buy already, then the price drop another 30%, then you ask yourself, what am I doing? So that's another story, right? But the cheap one, I think, is quite obvious one. Yeah. So come back to this, talking about the third bucket, right? To me, that one, usually I don't do that often. I don't scout for things that is cheap, usually. So because to me, if you keep on scouting for things that are cheap, then you bought when it's cheap, and then price go up, you need to sell already. So there's a lot of work that you need to turn your portfolio just because cheap things become expensive later, or price ran up. Whenever we talk about, let's say, semicon, and we talk about let's say like Nvidia, Tesla, and then you talk about US market, right? So the one word that people say that I just not going to put my money into these two buckets is because what? Oh, valuation. Valuation is high. And if you ask me, yes, I do agree that valuation is high. Also, same comment, right? It's not that difficult to know that the valuation is high. You just look at whatever metrics and then you just compare to the historical level, you can see that they are expensive. And I would use the word expensive and I didn't use the word bubble for a reason, because I do think that they are still, expensive, but still within that reasonable range. Okay. To me, it's like not like there's only one strategy, right? You can, partition it. And then once you partition it, at least you can carry out, implement one part first, and then you leave the two parts to be implemented later. I think that's fine. But for me, I usually, once I decided the allocations, right, I don't want to wait too long, man. I'm more like, FOMO one. The opportunity is there. Why you want to play the timing, right? If I play the timing that well, then I don't have to look for all this, opportunity already. I just time in and out, in and out, in and out. Then I become rich already. Just to wrap up all these things, right? I would say that whatever strategy that you can come up with, right? It could be, very complicated. It could be very sophisticated. I think as long as you can come up with something that you are fine with it, right? And you need to know that what kind of situation it can turn out very bad. Okay. Once you are okay with bad results, right? And sometimes you can just say unlucky lah. Okay. The timing sucks. Okay. But as long as you are okay with that, I think it is something that you can execute and you have no regret against it. I think that's the most important one, because I think investing, right, is hard enough already. And once you layer this difficulty of investing with the difficulty of the emotional management, right? And there's tons of regret, tons of FOMO, tons of all this, like you can't sleep well. Once it become too difficult, then you just, like paralyze and do nothing. Also doesn't work, right? Because if you do nothing or you just put your money in cash and then after 10 years, it will be inflated away. So
Thanks for sharing. I have 2 points here. I think
yeah.
first one is I will slightly disagree or push back on the idea or the concept that so-called quote unquote people that always hunt for value or so-called value investors, right, is they buy at cheap and then they sell when they realize the value or sell when it's over a little bit overvalued. I think yes, I don't disagree that there's a very big bunch of people that primarily do that kind of a lot of portfolio turnover, right? But
Yeah.
there's also the bunch that just buy the value and just hold good companies lah. But
Yeah.
the perspective is that I want to buy a good company, but I don't want to pay high valuations. Meaning,
Yeah.
the focus is also both on the quality of the company that can compound, but yet at
Mm.
the same time they want to buy at a decent valuation, not at I don't know how much they're trading at now, like 30, 40
Mm.
times PE are quite stretched in a way. So
Yeah.
that's the first one. Then I think second one also is why the concern about valuation is I don't know who said this, but I believe it's Damodaran,
Mm.
Professor Damodaran. He was talking about this timing the market thing, right? It's very interesting because a lot of people say that actually there's no opportunity to buy. You see, wow, all your tech company just keep going up and up and up. But clearly the facts disagree because even if you take the last 10 years or so, if you look at the Max 7, they all had their I don't know, DeepSeek moment, whatever moment you want to call it. Basically, in a way, they all had their own issues over the
Mm.
last 5, 10 years.
Yep.
So I just cite a few, right? You remember Amazon was still
Yep.
having free cash flow negative. We were joking about it, and I was still like, we were trying to buy extra position.
Yep.
People say that Andy Jesse, the hula, what's his name? Jeff Bezos stepped down. He don't know how to manage the business. He only know how to do AWS, anyhow pump money, build up FedEx, don't know how to spend, as in don't know how
Yeah.
to capitalize the business, and then stuff like that. And then moving on, Meta, the whole Apple thing, nobody use subscriber, no
Yeah.
growth, etc. Google, ChatGPT moment, they
Mm.
lost the AI race, the Gemini cock up, stuff like that. Apple, their China, which is today, the China sales is going down. So yes, services revenue are up, but sales is basically non-existent, revenue not growing.
Mm.
Netflix, the subscriber growth screw up at tier that time when it was going
Yeah.
down. Bill Ackman sold out. Tesla also whole host of problems. Tesla also went to 100 plus.
Even more problem.
Nvidia went through the crypto winter. So all of them actually had issues at one point in time.
Yep.
But the bigger question then you need to ask yourself is when there really is problems, do you dare to deploy capital or not? Or do you
Yeah.
believe in whatever? Because I think in every episode that I just mentioned, there are legit concerns. If it's
Yeah.
not legit, Wall Street or people won't sell you the shares at so low.
Mm.
And then the people that are selling Meta shares at $90, there's confirmed a reason, a very convincing reason that why they think Meta's margins is going to get crushed. Their goggles, their labs, whatever, their reality labs thing is going to be such a big screw up. It'll destroy their growth and whatever, their operating income. So I think the bigger question is then, would number one, of course, is do you dare to deploy when there's
Mm.
fear? And number two is when everything is rosy, expectations is being built up. Like
Mm.
today, you see Nvidia growing at phenomenal 100 plus 90%. It's easy to deploy lah when companies are looking good, because you can just
Mm.
pull out your spreadsheet, say, see, I project out 30-40% margin, I give you discount. Hey, the share price is still cheap. But then
Yeah.
I think it's back to the question again, what kind of personality you are, and
Mm.
whether what kind of market conditions you feel comfortable in deploying your capital. I think that's also a very big distinction there.
I think you are totally right. I think this is really temperament, personality instead of like the method. It's not like a logical method things. For example, right, you mentioned that, for those who only want to buy when it is really cheap, and then they are able to hold until forever, right? If you just observe these two act, right, only buy when it is cheap, but not selling when it is getting, like let's say fully priced or slightly overpriced, right? So these two also is like contradict each other. The consistent thing to do is that then now you sell first, right? Because it's already expensive. Because if you are not selling, right, you think you are okay having exposure to, let's say, overvalued names, right? Why are you not okay with buying a companies that is, let's say, like richly valued, right? For those people who really like discipline and really really use value investing, right? They only buy when it is cheap, right? Usually they will be quite diligent at looking for opportunity like this. So it won't be just, like that 3, 5 companies or 10 companies in their shortlist. They will just, do screener and then go and understand. When companies become cheap, they go and understand. And then when they show certain criteria, if it pass the criteria, they are okay to invest already. So it's like, let's say if you invest for a while already, you will see that, oh, I saw this opportunity, but I don't have cash. What do? Then you will be looking at
Reallocate
your
capital.
portfolio, and then you will
Yeah.
reallocate. So once you reallocate, right, you will be selling your winners already. I'm not saying that this is a bad strategy. I'm just saying that if you tilt your approach, right, more towards the so-called the valuation part, right, like you really focus on the valuation, right, the natural things to do is really some rebalancing. It's just that some people is like very quick one, 20% up, okay, done, I'm done with this trade, I'm
That's
out
how they
already.
get 20% kicker, right? Because
Yes.
all they need to do is constantly repeat 20%.
Yes.
But of course, the bad side is if the trade goes south, lah, meaning
Yeah.
you know that then you say that you buy a 12 PE, then it goes to 6 PE, then you drop 50%, then how? Like it
Yeah.
will affect. But I think actually a life hack, I think a lot of big investors in the space is, you know what they do? When the
Mm.
thing runs up like 3x, 5x, they take back
Mm.
the capital, they sell 20%,
It's the
then they
same
can tell
thing.
themselves that, hey, I'm playing with house money, no problem.
Yeah.
But then I get your logical inconsistency there,
Mm.
where if it's very, very expensive, why are you still
Yeah.
holding the company? Even if
Yeah.
still, because every dollar is considered like your capital allocation. So you
Yeah.
shouldn't be wasting the dollar when it's like very overvalued, even though it's so-called house money. Because at the end
Yeah.
of the day, it's still your money, because you can sell it in the market to get the money. So yeah, I get where you're
Actually,
coming from.
the house money is like some emotional trick that you play with yourself, but actually it's not a good strategy. Because you imagine, let's say if you just happen to find a companies that really do well, right? Say for example, in my case, right, it would be Nvidia. It really went up like 10x, right? If you ask me, okay, I didn't do that. I didn't go and sell and take back my capital when it 2x. Okay, I didn't do that. But if you ask myself, like, what's kind of error that I did here, right, is that my my mistake is that I didn't go and double down when the price doubled. And why people have that trick, right, is why? Because they are scared. Their fear is that whatever gain that they saw, right? Let's say you put, let's say 10K, right? Double already become 20K, right? They're scared that that 10K gain suddenly will go missing again.
But this is a very true fear, right? Because you
Yeah.
really actually see a lot of companies, right? Yes, I think compounding companies in the very, very long term, 10, 20 years, will go up. But a
Mm.
lot of these compounding companies in between is
Mm.
really roller coaster for 5 years. Go up, come down, then come back to your base price again. It really goes back down to, like we said, right? Because market is weighing machine. Focus on earnings per share. If the company can is able to continue create value, whether they invest in a high ROIC. If not, if they want to do financial engineering, they just keep buying back shares, lah, right? Reducing the share outstanding by such a large extent that it becomes such a monster because it's both a EPS boost plus a valuation. They just keep buying back shares. Then you also get a very big, good compounder. So I think in a way, at the end of the day, we still focus on first principles where company expected to make money, earnings supposed to be attributed to a shareholder. You just focus on that, keep growing, should be no problem, regardless of what story they try to sell you in the.
Everything just have to come down to the fundamentals, because you can say that, oh, out of how many thousands companies in the world, right? Like actually majority of them went bankrupt, right? And we never heard of them, like most of them, right? But can you show me one company that went bankrupt, right? But their sales is growing, their margin is healthy, they are generating free cash flow, and then their debt is acceptable level, and then they just went bankrupt, right? Show me one company like that, right?
Based on the conversation, it has been, I think, more than half an hour. You can kind of understand where both of us stand on this whole big tech AI semiconductor thing. It's not that I don't have, and I'm also going to show my current portfolio allocation. It's just that in today's market, really in 2025, when the market opened, I can't convince myself enough to press the button on many of these big names like big tech and semi. Of course, not saying that the whole industry or the whole sector cannot buy. In fact, because of the DeepSeek thing, I just joined Punti as a ASML shareholder. So I'm not saying that all cannot buy, right? I'm just saying that generally, looking at the overall valuations today, I wouldn't be allocating capital there for now. I think for now, the caveat here is for now. Of course, I'm very interested in adding exposure, or let's say 100K today I wipe out, I will want to be a future shareholder as well. But I'm just in a way trying to sieve out when is a good timing, a better timing like, compared to now at current valuations.
Then my questions to you is, what kind of trigger that we use to determine that, yes, this is the right time?
I think then if I go back and think about the big tech companies that I have, right, which is now, I think namely
Meta.
based on allocation, I have Amazon, Google, TSM, Meta. All these are considered your semi AI tech names, right? Amazon, when I bought, was when I was joking with you, when they were having negative free cash flow. So all these are why I can remember what happened for all these companies was because I was keeping tabs on them. I was tracking them, and everybody was saying that, oh, they how good, how good. This was all pre-2022. This was the 2021 hype cycle. Crypto was all to the moon. Everybody is hot, right? But I was keeping track. I didn't have a position. I think a lot of my tech positions started in 2022. And I also wanted to dispel the fact that actually buying cheap or saying that you're a value investor doesn't mean that you cannot average up. Say they glorify the idea of averaging down. Wow, I buy one lot, go down 10%, I buy two lot, go down 20%, I buy four lot. I keep increasing it. A little bit like martingale, but I'm just saying that it makes sense because you want to buy when it's cheaper, buy more when it's cheaper. But I think for my case, right, 2022 was a very short 1 year. I didn't manage to allocate a lot of capital. But after 2023, when they started to show recovery, signs of recovery, I continued to average up. So actually my percentage gains are so-called smaller because I have been averaging up in a way. But so Amazon, Google, I all bought when they were cheaper. TSM also during the down cycle in the semicon space. And Meta, of course, the whole debacle with Zuckerberg and his reality labs. So that was my own perspective. You asked me, is there a trigger? Is it an institutionalized process? I also don't know.
Yes.
But it's very obvious. You get what I mean? Like valuations ultimately is a quant game, meaning it's just a numbers game. You just put the Excel and punch a few numbers. These are my assumptions. You can expect this kind of growth rate. So it's not very hard. But the understanding of the quality of the business that one is hard. So I'm still learning from you. Actually, TSM was a pick that I took from you all those I didn't know because I don't read as much into the semicon space. So it was a trade idea in a way from you. But in a way, after I follow long enough, and then you just understand more. So in a way, that's how we develop ideas and hold really so-called for the long term. But I think generally back to the point, 100K theoretical capital now, I wouldn't add to big tech semi, but instead I will split it into 3 buckets as well. But it's not one third. So in a way, I think it's also back to the personality wise that what do you like to do? And truth be told, if you can manage to sit through 2 nerds talking about investment until this point in the video, right? I think we have quite a big interest in capital allocation and buying into individual companies. So I would presume that your persona is something similar like us, means you pick companies. So I'll say that 50% you will still allocate to individual companies where for myself now, I actually do take a keener interest into the China EU space. Meaning to say, I will maybe pick 5 to 10 names. You want to be equal allocation or blended allocation, up to you. But I will try to maybe split up maybe a 5%, meaning 5K each to 10 different high quality but attractive stocks that still trading at relatively good valuation. So I think looking into China standard, you have your tech companies that are still relatively cheap. I'm also looking into consumers, specifically your Yum China or Haidilao, betting on like the whole consumption recovery and whatever lah. You can say it's a thematic bet, meaning you want to bet on big sectors and you buy into ETF. But I think more so if you look at some of these great companies, right? They're just in a bear market, everybody all just throw all of them away. And yeah, some of the names, Yum China, Haidilao, looking at apparels, you have Anta, Li Ning. All of them are, I believe the last time I screened or checked them, they are trading at like 12, 13 times PE. I think yes, you can say that maybe clothing or apparel company don't deserve a high PE, but historically speaking as well, they are all still beaten down like 80, 90%. Not a good benchmark. I'm not saying that just because it's down 90% from all-time high, that's why it's a good company. But I'm just saying if you understand and appreciate the business model, their manufacturing capabilities, their sales, they're still growing. All of them are not, they don't have bad balance sheet. There's still some sort of runway, and of course you're buying in a bare, pessimistic outlook. There is quite a lot of room for bouncing back. That's the idea. Then on the flip side, you have your EU companies, you have LVMH, ASML, they're all, these are called China Plus strategies. I call them China Plus because they're all very linked or adjacent to China, the geography. ASML has the booking issues and the restrictions. LVMH also a very big part of the China consumer now, also pull back their spending. Another one I think interesting also is Novo. I think Novo also took a hit. I need to do more homework. I can't say I know the pharmaceutical business a lot, but yeah. And in fact, I think EU now, the very interesting setup that you look at the capital markets is EU doesn't have innovation. They don't have tech. Their car companies are going to gone. Manufacturing capability is all being stolen by China already. Japan is also slowly kind of going back. So actually what EU or Europe has in general now is the capital market has made it obvious. It's their cultural heritage. They're selling a ideal. So you see companies like
luxury.
Hermes. Yeah, you see companies like Hermes, Ferrari, they're all still trading at like 50, 60 times. People are willing to pay up the premium because they know that they really target high-end luxury. Compared to China now, a lot of the luxury companies all told because nobody's paying. Like luxury companies in Europe that are China related are down. China luxury companies are also down because really people not spending money. But for those that have a broader outreach and really target the highest echelon, like Ferrari and Hermes, I believe it was Monesh Pabrai. He was talking about Ferrari really targets a very innate need of men. Men are not ladies, are men. Meaning to say that they target those higher echelons where they really have too much money. They don't know what to do with the money. And they just need to bomb it on something that is very crazy, but they just need to show people that they have money. So actually the business model of Ferrari basically in essence is that. So that's why Ferrari people are willing to bid up. But going back to where Europe is positioned now based on capital market allocation is that they're betting a lot on a lot of these luxury companies, like real heritage, cultural icons. So that's how I read the market today. So I will put them on my watch list, but I'll follow them, but I don't think that I'll enter them. But more so I'll look at some of these like allocations on attractive valuations.
On these two, right? Like let's say talking about cultural, talking about luxury, let's say even like Ferrari, right? Like how do you know that this trend will stay? Because this is the part that I find difficult to just follow. I know that let's say today, if you tell me your auntie is buying LV bag, right? And then you know that after 6 months, she will buy another one. So people like this, they tend to continue to consume. I do see that, okay, that one become a habit, then it will stay. I think luxury watch is a market where people just want to show other people that, oh, I want to impress you. You see, I have a luxury watch, you know. So that was true for many, many years. It become a status. It's not something that tell you what's the time, because once you have smartphone, right, you know what's the time anyway. So it's not the time function anymore. It's just a status, right? Then I think fast forward 7, 8 years, I look around, right? Actually, there are many people, you know, those people which I think, you know, can afford to spend on luxury watch now. Okay, these are the people that I look at, right? Sometimes I look at their watch they are using, you know, like Apple Watch. So that to me is like they are eaten into this luxury watch market, right? So What I mean is, it's not to say that, oh, Apple Watch is better than luxury watch. It's not like that. It's more like, all this trend, right? Sometimes it can change from one period to another period. Then people just, the taste become different. But I cannot just say that I close eyes knowing that this trend will be there. When I look at the other one that I compare, is like technology trend, right? Technology trend to me is very simple one. As long as you have a product that is more, like better, right? Let's say smartphones, right? Once smartphones is here, it replaced the old, non-smartphones, right? To me, it's very clear. It's definitely a lot more useful compared to the old phone, right?
The game that we are playing here, right, is just because you haven't meet really rich people. Because the people that you're talking about is in a way the masses, right? I don't have the data. That's why now it's all speculation. But I would speculate because AP and PP, Patek Philippe and those two are the real high. They're selling like millions. Their watches are in the millions of dollars in the really high end kind. They are all family business, meaning they're so profitable that they don't need to be listed. They don't need to waste their time to expand because their market is not as big. They're not trying to target the layman. I'm trying to make a conjecture here in a way where I believe AP and PP, if they are targeting, if you're looking at the high tier segment, they are probably still as robust as ever. And in a way, when you compare it to companies like Ferrari, they are also really targeting only the highest tier. I turn the question again, right? Is I don't believe luxury will always be there because it feeds a fundamental human need, meaning people
Yep.
need to impress. People want to show people, they need to signal. The issue is more why your company? Why not?
Yeah.
I signal to another, I can use another company to signal luxury. Then here's the interesting thing when you compare to, I know this podcast called Quiet. So Quiet made 2 episodes, one on LV, one on Hermes. It's both 3-4 hours long. I think if you're really interested to know the space, I recommend you to spend 8 hours. You can watch it on 2x repeat when you are going to work. In general, how I look at it is this. When both LV and Hermes, right, they've created an ecosystem of creating art from all the way from training artisans from young to working for them, giving them long-term contracts, taking care of all these people so that all the handcrafted bags will have that so-called luxury and prestige, right? And there is a reason why all these companies are 100, 200, whatever years long. So it's very hard to displace cultural heritage. You can say that this mode is very feely, like, oh, I just feel that why I want to buy a Hermes bag, I can buy a good bag. Sure, you can buy a good bag. Then clearly you are not my target market. As in the conversation stops there.
Yeah.
I'm just thinking that if everybody, at least I don't know because I'm also not rich. I don't mix into their social circles, but clearly there's something working in terms of this cultural icon that why they can keep printing 10-20% easily for the foreseeable future that we all can see, and then they just raise prices. Everybody just continue eating up the Birkin or whatever other bag styles there are, and then they create a whole ecosystem. So I was talking about the Hermes. Sorry, I'm jumping a little bit, but Hermes is creating that whole ecosystem of artisanals creating the bag. So that is on the manufacturing part, and then they have limited supply, right? And then there's the pricing part, which is trying to price a premium, and then the third part, which is the buying part, which is where you don't walk into a Hermes store and say, "I want to buy a Birkins." So there's a reason why the resale value of Birkins are more expensive than the actual one, even though it's secondhand, because they create the whole system where you need to buy a handkerchief and then buy a scarf and then buy whatever to work your way up so that the sales associate will establish a relationship. So this whole entire ecosystem, you're saying that today Bunti creates a Bunti mess bag, and then because you sell at expensive, and then people buy into this whole cultural heritage, and you're trying to sell a story here. I think that's quite far of a stretch. I think it's really quite. I don't say it's zero, but I think from a risk assessment point of view, I really do think that there's something special here. So that's why there's a elusiveness and there is this premium. And of course, like I said, I can't back it up with data and stats like, your GPT, what's your adoption rate, how many million users you reach in how many days. That one is very clear cut, it's very logical. But this one, I think unless you can disprove it, if not, the story will run. Like it will continue running. And you can see that it's just a cultural heritage. And then this is on the company side. And then when you look at it from consumer side, you have people brainwashing you about why LV is a luxury. You look at people, they're carrying a Birkin bag, means that they have a particular status. They teach from young, and it's a worldwide phenomenon. That's why you see in Singapore, even people see MRT, they're also holding LV and whatever bags, right? So there's a reason you see a lot of all these since young. So it's a whole cultural, societal behavior norm that from a company and a society and behavior perspective, that it creates this loop. It loops together, like the loop doesn't end unless something really game-changing change. But here's the issue also. The funny thing about this is you compare the tech companies, today ChatGPT come out, tomorrow Claude come out, or Claude or whatever, then tomorrow DeepSeek come out. But I can tell you that at least for this, you have the peace of mind that even Bunty back come out, you wouldn't change anything. You get what I mean? Even
Yeah.
you can sell me a very good story. But of course not saying that there's no risk. That there always, like you said, the consumer taste and preference. So it's two sides of the same coin. How you look at this differentiation and how the company is able to edge in the competitive landscape. And of course, you look at LV, is also a serial acquirer. So they just keep acquiring and try to monopolize the whole. Even EU is very anti-competitive, but LV is able to. So this is how you assess the company.
I can understand that I can buy into it. It's just that for me, it's like maybe I didn't like in my circle of friends. There's no one that is like into this really like deep into luxury.
I'm not into. I
So
also
I
don't
really
spend. The issue is here's the funny thing. I also don't spend. I'm more interested in the business model and why they can keep printing money. You can see what the growth. You run screener, you can see that the prices of these bags just keep going up. Then sometimes resale prices are even more expensive. Every year they just keep going up 10%. So these companies are not like your tech companies that can grow 20-30%, can de-accelerate, then suddenly accelerate again, then de-accelerate, accelerate again. Don't have one because these companies are the very safe 5-10% go up. Every year I can keep churning out a bit more. Kind of a very steady, slow, steady compounders. And you can see in the share price also, they just slowly go up.
I mean, looking at the numbers don't lie. So no problem with that. It's just that in order to believe that, sometimes it's not just about looking at the numbers. Sometimes you need to feel the number. You need to know more than just the numbers to make up that, to really, pull the trigger to say that, okay, this is the exposure that I want to buy.
But anyway, back to the 100K thought experiment. So I said 50% in this. I said the other 20%, I will whack the S&P 500. Same thing, DCA, 2K per month. So that is 24K. That's around 24-25%. Why S&P 500? I think I just wanted to share my own experience here. Is that initially we all had that investor high. Wow, I suddenly have capital. I want to be a good investor. I want to be the Warren Buffett of Singapore. So I want to try to get 20% CAGR for 69 years, whatever it is. Then we always forget that actually we are still human mortals, right? So I think buying into S&P 500, to you, your justification is FOMO. Actually, to me, right, my justification is more like, number one, got two prong lah. One justification is I want to know the market performance, more for benchmark comparison. Because we know that a lot of us, I don't know about, but Bunty is a very, very disciplined guy. He focused on one brokerage. But let's say that now today you take advantage of a lot of all the brokers and stuff, right? So you have a lot of capital being split up everywhere. And when they do the compounded of the performance, it's all over the place. So unless you have a third-party platform and then you put in all your trades or on Excel and then you try to compute your performance, I think that's quite hard. On the flip side, if you do a DCA, and don't stop just because of 1 year, because of your capital, assuming that you have continued working, you continue DCA every time into S&P 500 on one platform, it's very easy to track the performance because you see that, if you have allocated the equal amount of capital on S&P, this will be the X percentage. And then you just compare based on your other portfolios on, are you winning or losing this percentage? And secondly also is, you guys know that I have an outsized allocation to a particular geography. So in a way, I think when you have a very long enough time horizon, allocating to the S&P 500, it allows you for that passively growing your wealth. So in any case, 50% kaboom, right? The whole thing go kaput. At least you still have this passive investing. It will set you back quite a while, but at least it still helps serve as the foundational layer to your retirement in a way. So you can say that I think sometimes people will try to advocate for 50% in passive, the other 50 or 20% you play around. But in a way, like I said, why I said that is more like personal preference. Meaning to say, if you're a stock picker, you want to test yourself out, go through the rough waters in the investing world, then you can do 50%, 20%. And then of course, the last 30%, for now, I will probably allocate it to money market funds or short-term bonds that yield a high savings rate. On another note, if you are interested in doing the quant exercise, I also did discuss with Bunty offline that I do know quite a lot of friends because like right, I'm more value oriented and I so-called attract all these cheapskates. So it just so happens that in my network, that people that reach out to me or we form a relationship, actually not a lot of people are like you, Kelvin, that are Tesla growth investors. I also don't know how we became like friends or go into my network, but a lot of the other people outside that are not creators, right? Uh, uh, that's another side note, that interestingly, a lot of the creators are very Tesla focused or very concentrated on Tesla. But on the other side, a lot of them keep pitching a lot of net ideas. Net ideas meaning their price to book are less than, Hong Kong now, because it's in a, even though it recovered quite a bit, but a lot of the companies, especially property related ones, financial related ones, they are all in shambles. Long story short, there are quite a few, some gaming companies as well, also selling at very, very cheap valuations. Of course, they are all considered, I wouldn't say micro cap, they're probably small cap, few 100 million, and they are all trading at like the balance sheet, the cash can be more than the, you net out the debt and can still be more than the market cap, that kind. So in this kind of net place, these are called real value investors. Actually, we are all considered fake value investors, meaning we are like a little bit more growth at reasonable price, then you are more growth oriented. So we are all in the spectrum, right? So all these net plays, if you are very good at them and you can take a 30% play into 10, 15 companies and then wait for a few of them to revert back to their value. I think at a 0.2, 0.25 book, you go back to one book is 4x, just saying, in a relatively short time if you need so-called catalysts to unlock the value. So I think if you are interested in those, to me, I think it's a skill set issue. Meaning to say now, some people like to say that actually you should play net when your capital is small because you can very easily, very quickly roll the capital because of the if you can find good catalysts and good companies that can unlock quickly, then you can recycle the capital again to find the next one and then keep rolling. I do know of people that do it that way, but I think for myself, I think 2 points. Number one, I'm not as confident in terms of the quant is okay, but I think the identifying of catalyst one is not okay. So that's my personal view.
Right.
And secondly, is if I want to play net, I will think of it more as a theoretical, like, or investing theoretical exercise, and I wouldn't allocate like outsized capital. So and it's very time consuming. So that's why at this current stage, I wouldn't do it. Maybe when I FI, meaning if I hit whatever number that I have and I have more time, then I'll look into those net play. So that's just my sharing lah. So that's how you do 50, 20, 30.
I have one last question, not
Please.
related to this last part about net now. So
Please.
since this DeepSeek is the hot topic, right? And I know that you have been monitoring NVIDIA with me, right? So I just want to hear your take on this. Not so much about like what will go, like what's going on with the share price. It's more like, let's say we look ahead 3 or 6 months, right? Do you think that this one will have a big impact to the AI space? And that's first question. Second question is that are you paying attention to whatever happened in China? Say, for example, the DeepSeek model itself, or some Alibaba models, they also come up and claim that they are even better than DeepSeek, right?
Specifically for NVIDIA, I agree with your take. So I've read quite a lot of like good people writing long ass blog articles explaining the mechanisms and whatnot. And there's a lot of aspersions being cast saying that, oh, they're skeptical about China's model and what. So even though I'm very biased and very bullish about China, and actually I saw the Spring Festival, the robot, the dancing with the handkerchief thing. Yes, I think all those, even with all those in mind and my biasness in mind, I think let's try to be more grounded in facts and the current state of things. China is good in manufacturing. China is good in terms of ordering, reconfiguring the supply chain, scaling. All these are good, but there is a real concern that because I believe it's YCX that say that there's a mother model which is trained by NVIDIA, OpenAI using NVIDIA's chips, and then the baby model that's created by DeepSeek that uses some sort of API to pull out the data. It's getting, I don't want to go too technical, but I think in a way, US is still on the frontier on many of all these models. It's conquered by some of these greatest people, like whoever your NVIDIA CEO, even Eric Smith, the ex-CEO of Google and stuff. China is still like behind. There's ranges of 6 to 12 months to 2 to 3 years. I don't know what, but I do believe in their assessment because they are the real experts in those fields. And even people that comes out, like even from Baba, whoever the spokespeople say that we know, right? Because as consumers, in the EV space, I think China can claim that they are already in front of a lot of the competitors like Japan. I don't know whether they can fight Tesla in US, but even Tesla has a factory in China. So it speaks volumes in terms of why people want to be based in China. But back to this AI topic is, I don't believe that they are anywhere near in terms of dethroning the current big players. So that's number one. So that's the first fact. With all these restrictions in mind, I don't know. I believe in my fundamental thesis. I believe in the Jevons paradox. So I do believe that, especially if we continue accelerating the adoption, people are spending even more money and time and investments into this whole space. And I believe, or at least I buy into the future, that it'll be agentic, it'll be integrated. The circuits and the chips and whatever will be integrated in everything. Everything will be AI driven. So if you believe in that world, there is still space for Nvidia and ASML and TSMC to be a big beneficiary in this next world. So that's the second assumption. I think that there is no close competitor to the current chip ecosystem, meaning your SMIC or SMC. I forgot. I keep mixing them up.
SMIC,
Yeah,
China.
SMIC. Yeah, China one. SMIC, Huawei, whoever. All your big competitors to the three so-called dragon heads, which is your ASML creating the machine for TSMC to create a chip for Nvidia to run all these things. These three, mainly the main supply chain, don't have an equivalent in China. It's not like you have Facebook and then you have WeChat, or you have Amazon, then you have Alibaba. It's not like that. So if I don't see that world, meaning there's an alternative system now, I don't think you'll do anything to this tree. So there's a reason. That's why I also added to ASML in a way where I still think that they're the gold standard. Not even gold standard. There's no bronze standard. There's just gold standard. Yeah. So if that's my three assumption, that's why I think that these three companies are fine. Meaning they're no problem. Of course, the demand, you can argue about whether big tech will continue spending money. This is out of the area of my expertise. I just know that these companies that I own, Amazon tell me how much they're going to spend on capex. Meta tell me how much they're going to spend on capex. They're going to spend. Whether they pull back or not, we don't know. But we take it at their word that 2025 spending is still kind of warranted, meaning it's kind of confirmed. So that's on that part. So that's why I say on Nvidia's case, I agree to your take that DeepSeek or Alibaba's Quen, they are fighting on the AI application level. So all these bottom layer that is enabling this actually should benefit from this scaling down or this competition. So that's the first part. Second part of the question is the Quen one, right? The Alibaba and China models. Actually, I do believe that China is doing a lot of interesting things. I'll give you an example. In 2019, actually, I don't know whether you know of this function where ByteDance, I believe it's ByteDance or Alibaba, I think all of them have already. When you look at a video on a live stream or whatever, you're interested in what the person is wearing, you can double click and then they'll immediately give you the link straight to buy that what the person is wearing. And we haven't talked about what ChatGPT, what OpenAI, all this nonsense, right? Nobody talk about large language model. So large language model is more towards productivity gains in knowledge workers. But I'm saying that in general, right, when you look at artificial intelligence using algorithms and what, there is a reason why TikTok can sweep the whole world by a storm and get few 100 million people in US to spend so much money and created so much business opportunities. This was created by a Chinese founder. You don't smoke me what Meta, what is Meta doing, what's Google doing, what's YouTube doing. I think all of them slept on the wheel and they lost to China. That's simple as that. So, but there's only one vertical of artificial intelligence, right? So you have your large language models, you have your algorithm, 算法, your recommendations and whatnot. So I think when I look at it as a whole, it's just that some people are winning in some areas. They are very focused in developing one area of their vertical. That's why they come out better. So TikTok and ByteDance in a way is very, very focused on social media engagements and algorithm, their 云算机 whatever. So Alibaba is very interested in their cloud. There's a reason why they're also the first player in China. And just don't forget that China is very competitive. If you really can come up as number one, when you have Tencent, ByteDance, everybody behind chasing you, there's something that they're doing right. So that's my assumption as well. Now, I still believe that they are a lot behind, especially with the restrictions now. I don't know whether they circumvent with Singapore and what Nvidia chips and whatever. I don't buy in all those narratives. I just want to see numbers. I like to see in their earnings and their growth. So that's my thing.
There won't be any. It's not listed. Let's say DeepSeek is not listed.
But Ali is listed. So
but, I mean, it's not that easy. There's no separations of unit, right? Like this is a segregated one.
They did. I mean, they only float numbers, but it's very not transparent. Meaning to say, they say that the AI related application up triple digit, but the triple digit is from a very low base. So this thing you can kind of monitor in a way where after 1 year, 100% radio or a few 100% increase, then how long can you keep triple digit growth? You get what I mean? So their cloud also will reflect revenue. That you can see one. I mean, if you follow the company long enough, you will see. You just need time for it to play out. Yeah. So this kind of thing is you follow long enough, you will tell, you can be able to tell. But I think we are still in very early innings, and Tencent is exceptionally quiet. So it seems like I only hear ByteDance and Ali talking about it. I think Tencent own self check out of the game, like then screw this thing. Last time they got report cloud, then they merge it in, then they hide the numbers. So yeah, you can really tell that everybody has their own focus. And once they focus, I think you shouldn't underestimate them. That's just my general thoughts. It depends on where you sit on this thing. I still think that like the three companies we talk about, the ASML, TSMC, and Nvidia, that chain won't be broken. Everything broken is after them. Like your Meta, Llama, OpenAI, whatever. That one, I mean, they're not listed anyway. I mean, when you really think about it, right, Meta's, Llama, and Google and whatever, right, the main business is not selling LLMs or not selling subscription to that. They're integrating all their learnings and innovation to their core product. So actually, you still need to focus on their core product, not so much on what they are doing there. What they're doing there is you can say that they're building a moat. Yes, Zuckerberg keeps saying that I'm trying to build a moat where you open source everything and then you commoditize the whole thing and you integrate it back to Meta's main algorithm and internal servers, right? But that's not the main concern anyway, right? There's the operating. You should focus on their main business. Where I would be more concerned if Snapchat today has a mind-blowing thing that allows for users to migrate. That's a bigger concern rather than whether Llama is underperforming or outperforming Amazon's new model. So yeah, all these I just read for fun, but I don't put much thinking or thoughts about behind them. But that's just my general thoughts on China's state of the AI now. I just don't be too fixated that like LLMs is the big thing in the US today. Everybody say that, wow, it's going to change the world. Yes, it is changing the world, but AI is not so hollow. It's not just one thing that they're working on. Everybody's working on so many different things. So yeah, you continue seeing. I think TikTok was the biggest breakthrough to the whole world that China is working on something. So we will see whether there's a second or third breakthrough that really can invert the whole industry in a matter of months. Yeah, that's just my general thoughts here.
All good comments, but later Nvidia still come down, drop by 50%.
Yeah, so
who knows?
caveat. So caveat here is okay. I think one important caveat here is that, like you said, right, because Nvidia's business driver is not so much about China. China is not important.
Yeah.
Nvidia's business driver, you already know that it's all about the spending and the ability for them to iterate to the next model, and then Blackwell, is it? How efficient is Blackwell? How Blackwell will be able to help lower compute or increase compute power, whatever it is. So that's the bigger concern as an Nvidia investor. And one more side note is that actually I'm interested in buying Nvidia, but I'm waiting for the next cycle. I know semicon. I don't know. It's a personal selfish desire that because I have no exposure, I want to buy Nvidia, but I don't know how to buy today. I don't know how to buy. Not I don't want to buy. Yeah, I don't know how to buy.
Opportunity is coming.
Yeah, we'll see. We'll see whether it comes. Yeah, I'll just wait. That's my bigger, my takeaway. Okay.
Thank you for your sharing.
Yes, I think thanks everyone for listening in. I don't know how many of you stay until at the end, but okay, Ken. Goodbye.